The amount of stimulus promised from each presidential candidate is one of the most bullish factors driving stocks higher. From Harris, a $25,000 down payment for housing assistance. Trump, record low corporate tax cuts. Fully tax-deductible car loans, eliminating tax on overtime, tips, and Social Security benefits, and both candidates will increase the child tax credit. This is fiscal stimulus, massive economic spending to make sure consumers keep on spending. Political-driven rhetoric may have people believing the market will crash if their party isn't elected, but the truth is the market doesn't really care. The market typically pulls back before the election because it wants certainty before positioning for each scenario. Trump, bullish for crypto. Kamala, bullish for Chewy. Either way, the federal deficit is set to explode. But don't worry about hyperinflation. The bond market is raising long-term interest rates, which is why mortgage rates are reversing back up, completely contradicting the Fed's rate path. According to the Fed's latest report, low-income households have depleted their savings, but high-income households have more than made up for the weakness, led by millennials. Now, I thought it would be boomers, but retiring means you must be cautious about outliving your paycheck. High-income households have experienced the wealth effect. Their assets have increased in value while receiving more interest income from higher interest rates. This combination provides a strong stimulus for sustained spending, so the rich get richer. Now looking at the data, initial jobless claims jumped, but that was no surprise to the market as the chaos from hurricanes is already priced in. And last week pretty much confirmed the labor market is not falling apart. In fact, the economy may be too strong, and now Fed Bostic is suggesting the Fed may need to hold off on rate cuts to avoid overheating. The latest inflation report revealed another drop in the inflation rate, but more stickiness in core, which excludes energy and food. Now, of course, the perma-bears are going to tell you inflation is re-accelerating, but the real confidence came when shelter inflation ticked lower, led by the deceleration in new tenant rents, so renters can stop complaining. Let's move on to markets. Finally, China stocks are pulling back, offering an opportunity, an entry, and this is either the greatest opportunity in the last 10 years or a complete fail. Either way, the government is committed to driving markets higher, so all eyes on Alibaba, JD, Baidu, and some of the ETFs like KWEB and FXI. AMD released the new MI325X chip to rival Nvidia's Blackwell, which could boost the stock if the chip is seen as an alternative, a substitute for Nvidia's Blackwell. Unfortunately, chip switching isn't as simple as switching from Coke to Diet Coke. We'll see what happens. Tesla unveils its Cyber Cab, a 2-passenger autonomous robotaxi with no steering wheels, no pedals, and expected to go into production by 2027, so 2030. Now, of course, after the event, Tesla sells off and Uber hits all-time highs. Investors were just not impressed, citing a lack of details and no mention of the Model 2. As far as sectors go, financials, industrials, and technology led the market this week as all three sectors made new all-time highs from the equal-weighted perspective. Nvidia leads tech. Caterpillar continues to hold all-time highs with exposure to China. And financials, JP Morgan is pretty much the only stock that actually goes up. Now the S&P is at all-time highs, and this doesn't mean the rally is over. On a year-over-year basis, momentum has not yet met its peak, so there is room before it gets completely stretched. Margin debt levels are still below the 2021 high, with $6 trillion of cash on the sideline. This is not a cyclical blow-off top. Stocks have more room for upside. Around the world, governments are spending, central banks are easing, and the best way to hedge inflation is to own assets.